Money FM 89.3. Best of breakfast. Companies to watch.
All right, from Kennedy to Dan K, we've got Dan Ko on to talk about some of the companies you should be watching out for.
Yeah.
Good morning.
Good morning, Ryan H. How are you doing today?
Doing pretty good. How are you doing?
Not too bad. We had a very good lunch that bonded the breakfast team just yesterday. I had a lot of fun. And I'm still dreaming about it. But yes, welcome to Companies to Watch. That's a segment where we spotlight and stock you up with ideas of listed companies that will call for your attention. So we're looking at market trends to risks, as well as hidden gems or warning signs to steer clear of. 8855-0893. Text us and tell us whether you think it's going to be a hot or not.
All right,
Ryan. Today we're talking gaming. You like gaming?
Yeah. What type of gaming are you talking about?
What kind of gaming do you like?
Life is about fun and games. So,
What?
Video games, yeah.
Video games, okay. Do you play any video games now?
I am getting back into The Sims. Have you heard of this game, The Sims?
The Sims, like that human simulator.
Yes. So you can create your own house and have your own people walking around.
What do you
have
do
your
on
own
The
jobs.
Sims?
Sometimes they're swimming in the pool.
Is life not a simulator enough for
It's more predictable. I can control their lives. I don't know. I get a kick out of it.
you? Okay, fair enough. But we're not talking about video games, Ryan. We're talking about casino gaming. And apparently there's an attraction to it, the thrill of trying to beat the house and walk away with a big win for some people out there. But for investors, though, the appeal lies in a slightly different reality, understanding that the odds reliably favors the house. But investing in this industry is hardly ever straightforward. The sector faces meaningful risks, with potential tariffs in the second half of 2025 threatening to dent discretionary consumer spending, while economic uncertainty could likely amplify the pressure. But in light of these complex forces that we're seeing, we've got JPMorgan analyst Daniel Politzer taking a closer look at how investors might be able to profit from these companies within this sector. So, as we all know, gaming is a value-oriented sector and valuation is relatively important. Long-term secular trends or capital structure changes may have an outsized impact on long-term share performance. So, building on that framework, here's one gaming giant that stands out in this environment. Are you familiar with the name Penn Entertainment?
Penn. No, not quite. What do you do?
So basically, their roots traces back to more than 50 years ago to the Penn National Racecourse in Pennsylvania. And they first started out by, doing bets on horse racing and eventually moved to casino gaming and later into hotels and resorts. So think of it as like a Resorts World Sentosa.
Okay.
Yeah. So today, Penn operates about 42 destinations, including casinos and racetracks, as well as hotels. So as a major entertainment experience provider, they boast over 7,800 hotel rooms with more than 50,000 gaming machines, 42 casinos and racetracks. And the reason why I've brought them to our attention today is because just recently their first quarter 2025 results reported top-line growth of $1.67 billion. That's up 3.7% year over year. So it seems like people aren't exactly holding back their spending on gaming, casino gaming specifically, but though it did miss estimates though. So Penn finished the first quarter with $591.6 million in cash and cash equivalents available, as well as a traditional net debt of just over $2 billion. What do you make of it so far?
Yeah, that's quite decent. Things are up, maybe not to expectations. It's still a growth market by the looks of it. So still quite encouraging numbers.
Yeah, I like to think that they're kind of holding it well or altogether, especially in light of the recent economic environment that we're in. And even despite, the face of, missing estimates, JPMorgan initiated coverage on Penn with an overweight rating and a $24 price target earlier this week. Just recently, they were trading at about $18. That's down 8% year to date. So according to Investment Pro data, the stock currently trades around the $18 region. But analysts are targeting ranging from $16 to $30. And JPMorgan did say that, Penn Entertainment's attractive catalyst path with approximately $1 billion of new projects that's scheduled to open in the next 2 years might be a key factor in its positive outlook. In fact, these upcoming projects could potentially drive upside to current financial estimates, where the company currently generates about an annual revenue of $6.6 billion with a 40% gross margin. So the firm also did highlight Penn's lucrative market access fee stream, noting that this is the only aspect of the company's interactive business to which it assigns any value in its analysis. So it does seem like this represents a significant positive factor in JPMorgan's assessment, which is why it's supporting their target price of $24, which indicates some strength to the stock in the next few months ahead.
So I'm looking at the casinos that you've mentioned. So they've owned more than 40 properties across various places, and that makes up 85% of their total sales in the FY 2024. And then the interactive segment, which of course is online and so on, that's 15%, which you imagine would go up in time to come.
Yeah, exactly. But that being said, though, we're still seeing a lot of economic uncertainty playing out within the market landscape that we're in now. And in fact, with tariffs set to, change things and shake things up on July the 9th, to me, I feel like at least if I'm going to have to give a verdict for the stock, it probably would have to be a not. And that also comes against the backdrop of their potentially failing partnership with ESPN. So apparently, their partnership, which dates back to about, 2023, where both sides hope to challenge brands like FanDuel or DraftKings, the top of the sports betting market, it seems like this is slowly falling out after 2 years. It's worth $2.1 billion, by the way, Ryan. And during the recent earnings call, Penn Entertainment CEO Jay Snowden did kind of say some ominous words about the status of their partnership with ESPN, admitting that, they're not on pace to hit their goals and suggesting that the deal could fall through by 2026.
Looks like that bet if ESPN did not pay off.
Exactly so. But at least according to the various consensus rating that we're tracking as of the 3rd of July, we've got TipRanks, Yahoo and Barron's still giving it a buy rating. And that pretty much wraps it up for our analysis of today's stock in focus, Penn Entertainment. All right, Ryan, here's some fun facts about Penn Entertainment. Now, Penn Entertainment is listed on the NASDAQ, and it actually kind of makes it one of the few publicly traded gaming companies that's not based in Las Vegas. So that kind of makes it a little bit of Wall Street underdog in Vegas-dominated space. Well, that being said, why couldn't the PC gamers stop crying?
Oh, wow. They lost their games?
No, because he refused to be consoled. And that's all we have for Penn Entertainment.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.